Hey guys, this is Market Organized. Today I want to talk about the most important rule of trading and the number one, the golden rule of trading. It's cutting losses short. And I know some of you may have heard it, and some of you may be like, what is cutting losses short? So it's very simple. I promise you, after like 5 minutes, you will understand what it is. So cutting losses short means that, uh, let's say you buy a stock at a $50 a share, and the stock goes down to $47 a share. You get out for a small loss. You only lost $3 a share, but if you don't cut your losses short, and the stock, let's say, drops to $25 a share, then you lost half your money, and that's not cutting losses short. That means you didn't cut your loss short, then you lost a lot of money. So cutting losses short is pretty much, that means, like, get out before it's too late, preserve your capital, and it's about, actually pretty much it's about capital preservation. So now I want to go into detail. Let's take a look at a chart. I picked two stocks on purpose. Number one is Apple, and the other one is Cisco. These are very strong stocks. But I want to give you guys an example of what cutting losses short mean when you are actually trading. So let's get into it. So this is Apple, and this is Apple back in the days, I would say. Let me, not back in the days, but I would say, let's see the time here. Um, I'll just cancel it here. So this is back in 2010 when it was very strong. So if I draw a line here, a horizontal line, so this, it was trading at $40 a share, and and then let's say you put your exit strategy around here. So let's say you bought here at the breakout, and then let's say you said, "Oh, I want to get out when it hits $33 a share." So in this case, you didn't have to cut your losses short because the market went up. I mean, the Apple went up, and you pretty much made money. So in this case, everything is fine. But let's say you're thinking about buying here, pretty much. That was a little late, but if you were thinking about buying it there for some reason, uh, and then you wanted to get out somewhere around here, right? So now it went up, and the market came back down. So this is actually will make it very emotional for you, because emotions, remember, in trading is full of emotions, because you have money on the line and you are trading to make money. Everyone is trying to make money, but there will be a time where you're gonna have to lose. So this is one of the examples here, where the market went up, where Apple went up, and it came back down. So if you didn't cut your losses short, you would pretty much end up losing a lot of money here, but this time the market came back up. So you got lucky. So look at that. Apple came back, and then eventually you made money. All right. I know it sounds good. I know it sounds reasonable and plausible. So you might say, like, why would I cut my losses short if stocks if the stock will, you know, recover? But the problem is this. Apple did this, but there's so many stocks that don't do that. Like, there will be stocks like Cisco. Cisco, believe me, it's not. It was as strong as Apple like today. So let's take a look at Cisco. So if you take a look at Cisco back in 2000, when the market was very strong, so this is like a similar pattern or a similar trend. So let's say for whatever reason, you bought here, and and you had a plan. If things go bad, you were trying to exit here. So you bought at $70 a share, and you were trying to get out at 62 if things went bad. So this time it went up, it went down again, and you got stopped out. But if you didn't cut your losses short, look what happens this time. So the market keeps going down. Cisco went down, went down. So by 2001, we find ourselves around $20 a share. So this is pretty bad. So if you probably lost like more than half your money at this point. But let's see if it's gonna recover. So I know we're in 2016 right now. So if let's see. So as I go sideways, nope, still $30, still 26, 31. So it's 2016, and it's still trading at $31 a share. So that's pretty bad. So you bought it at $70 a share, and after 16 years of waiting for 16 years, hoping and praying for the stock to come back to where you bought it, and you still finding yourself, despite all that stuff, like you're still down about 50%. So that's a very bad strategy. So the point I'm trying to make is the reason I picked Apple and Cisco is because they're very similar stocks, and Apple, you got away with it, but Cisco you did not. But the point I'm trying to make is you have to cut your losses all the time, 100% of the time. If you don't cut your losses 100% of the time, there will be one stock that will destroy your portfolio, and that's not the uh, route you want to take. So remember this all the time. Cut your losses short, get out before it's too late. And to do that, you got to have a strategy, you got to have a plan, and you need to practice your emotions. Controlling your emotions is actually the number one thing you want to do. You want to master when it comes to trading, because trading is all about emotions. And when people get emotional, that's when they don't want to cut their losses short. They're like, "Oh my God, the stock is going down," and they're just praying and hoping and for the market, for the stock to go back up again because you're losing money, and when it doesn't do that, you're in trouble. So that's it for today. And if you guys have any questions, please leave a comment. And thanks for listening. And I'll do more videos next time. Thank you.